Good afternoon, everybody. It's Christian Thwaites at Brown Janikowski. Thanks for joining us today, November the 16th. It's difficult to think how quickly this year has gone. And so we've got Thanksgiving next week and then barreling into the year end. Still, the markets have been pretty active, as you know. As of today, the S&P is up. I'm going to give year-to-date numbers. I mean, things have changed a little bit. In the sense that we did well up until March, April, took a bit of a summer lull, did a September, August rally. But S&P is up 25%. Interesting enough, the S&P equal weighted, which takes out the big weighting of the big tech guys, the 5 or 6 companies and the tech weighting, which is about 32% of the index. So it just looks at every single 500 company equally, 0.2% of the portfolio. That's up 27%. And that's important because the broader the market rally, the less nervous I certainly am. If it's all being done by a few names getting on historical and stratospheric multiples, then that's one market condition that isn't necessarily terribly comforting. But if you're seeing a broad range of stocks rally, then there's a little sort of better optimism with that, because it means that more companies are benefiting from the recovery, and it's not as lopsided as it was in 2020. Small companies too up 34%, so it's like a 7% increase over large companies, and the same story there. Smaller companies, are smaller. Most companies, small companies, stay that way. There's a bit of a myth that they end up being Goliaths and be more cyclical, have more debt, and be more focused in their market. So if you see a rally in small cap, it usually also means that the economic recovery is spread out. So that's good. That's 2 indicators we got. Nasdaq continues to do its thing. Nasdaq is really a shorthand for the top tech companies. That's up 25%, so pretty much in line with the S&P. And then Europe is up 15%. Japan down a little bit. International has not been a great performer this year. An emerging market is negative, which we discussed in the blogs before, and that's mostly China, but also some indebtedness, trading, and inflation problems in places like Brazil. Anyway, so that's where we are. Any portfolio this year would have made quite a decent amount of money on top of a 2020 good return as well. So we've obviously got a lot to be grateful for as investors. But anyway, so here we are. Now, this headline came up this morning. And so this is the big retirement fund for Calpers. Now, as you know, probably Calpers is probably almost permanently lagging in its investment returns given its obligations. And so if you're a pension fund without enough assets to your liabilities, you can either increase contributions, you ask employees to put in more, or you can cut pensions, not usually a very popular move, or you can decrease your investment returns, or you can do what these guys are about to do, which is that they'll lever up at presumably fairly low rates and go more into alternative assets. Now, far be it from me to critique the Calpers guys. This probably is not as sensational as the headline shows. They're probably doing about 5 or 10%. But when you kind of think of, what could go wrong? Well, if you've got a giant fund, I know this is like $600 billion or so, levering up to go into alternative assets. Leverage is short term. The rates you borrow at fluctuate. An alternative asset is incredibly illiquid and will only get kind of repriced about once every year or so. So there's definitely some fraud in the market. Whether it's these kind of things or electric vehicles, there's plenty of places where the markets are pretty heady. And when I see a headline like this, you think, really, they're going in at this stage of the cycle to go into risky investments with borrowed money. So we're certainly cognizant that that while things are looking good across the economy and the stock markets, there's things like this will come back and be quite an unpleasant surprise. But anyway, let's kind of talk about where we are in November. So the good news is the COVID-19 rates have well, the bad news is they've stopped falling, but the good news is they're much lower rate than they were. But there is a slight tick up, probably the seasonal effect, and so it's around with us. It was a very big hit to Q3 GDP. So we had a 6%, 7% print in Q1 and Q2. And Q3 estimates started at 8%, ended up at 2%. So that was the whole COVID Delta 19 sweeping through and kind of cutting back activity. And it does mean that I think a lot of that will be pushed into the fourth quarter, and we're looking at a really robust fourth quarter growth. But I kind of want to put one thing out here, which is that it might be that we're living with COVID for a long time. Whether there's other strains, I don't know. I'm not in a position to judge it, but it does seem like this thing may not go away in the sense that it's never an issue anymore, or if it does go away, it may not be for a while yet. And that's going to mean that there's going to be full starts, full storms and so on, and then kind of accelerations and caps, and that's kind of what we're in now. But I would say that perhaps COVID is still going to be talking about it at least 6 months from now, possibly longer. Inflation is the big debate. So that is something which is essentially in two broad camps, although they're kind of staking out rather extreme grounds at the moment, which is that inflation is temporary. It's due to a few sectors of the economy which have got hit badly by COVID, supply chain management, and a few sectors which have just not to meet demand which they've had. Then there's which is no, it's likely to be much for much longer. I have sympathy with both camps. I think that, make no mistake, the 2009 to 2020 inflation period was incredibly low. I mean, there was never any sustained time where the inflation was hitting 2%, and that was with the Fed throwing easy money at it for the best part of a decade. We just could not get out of a very low inflation environment, and that that has problems for wage increases. And while it's stable and everything, it's usually compatible with slow growth, which is exactly what we had, 2% growth, for about 10 years. So I think that a slightly higher level of inflation is nothing to worry about. I think we will get. We know that higher inflation in the next few months. And don't be surprised by the headlines. We know that the used car prices are high. They're not likely to fall in the next couple of months. We know that new car prices are high. They're not likely to fall either until they kind of get the supply back online. Both those two are 7% of the index. So that's going to be a very high part of the CPI. I hope everyone can hear me. I hope I'm okay. Debbie, if you're having a problem with the sound or anything, just let me know.
Will do.
Okay. Yeah. So I got a call on my phone. Second. So the other thing on so inflation is going to be high for the next couple of months. Just you'll see it in the newspapers. It'll be headline CPI. Some of that is again these opened and now closed and then opening sectors. I'll cover those in a little minute. Also the energy costs, which are much higher than they were a year ago. So people are spending a lot more on gasoline and energy costs and heating going into a winter time. And even today, we're going to have a big spike in natural gas prices because Germany's put at least a kind of review on the Russian pipeline coming up to speed, and that will definitely affect natural gas prices in Europe. And if they have a cold winter, it's going to be doubly worse. So anyway, expect inflation to increase a little bit. It's really what we're looking for in the new year that matters, and what things begin to subside. And I think they will. They'll come down from these headline rates of 5 and 6 to much lower than they are now. The other thing that we have is negative real wages, and this is really important. Is that to get a good inflation cycle going, you have to have an increase in nominal and real wages, where people are asking for and getting wage increases which are keeping up with inflation or exceeding it. Then you've got that kind of wage price cycle, which many people have talked about, and if you lived through the 70s, you've probably experienced it. But right now, we are seeing real wages fall. So even though there's been an increase in lower paid jobs, from the minimum wage and the bottom sort of quintile of people, of earners, it's still not, still not exceeding the real rate of inflation. So if you don't get high increased real wages, it's very difficult to have an inflation follow through. People don't have the money. The Fed taper announcement, that's done. So they're going to just cut the quantitative easing, the bond buying from 120 billion down to zero, cutting $15 billion a month until next May or June when it will stop. So remember, this is a tightening in the very, very sort of technical sense of the world. They're still adding. They're going to add another, I don't know, 300-400 billion to the balance sheet between now and June. So there's still a presence in the bond market, and if you're adding assets to the bond to the balance sheet, albeit at a lower rate, you're still taking money out of the bond market and putting it into bank reserves. So that will be done gradually, and we expect rate increases. We had put back end of 2022. I think it's more likely to be in the middle of 2022. That obviously, if inflation really persists and stays high, then you might get something accelerating from that. But at the moment, kind of think a 2022 mid-year rate hike is on the cards. Employment is stronger, much stronger, whether it's claims or new farm payroll numbers. Disappointing September, much better October, likely to be a better November, December, January. I mean, we look for 500,000-600,000 at least from the 160 we had back in October. But we've still got a much smaller labor market than we did. It's about 5 million less people working than we did in the peak of February 2020. And some people, will stay out of the market. Some people retired early. But the interesting thing is that the participation rate between women aged between 25 to 35, and then people aged 50 to 55 has dropped. And to me, that's a proxy for childcare problems. If the schools are closed and one of the wage earners has to stay and look after kids, then that's where it's going to show up. So some people who cannot go to work yet until all of this is cleared up. As they do, I think the re-entry into the labor force will begin to accelerate. We've got a very low participation rate right now. It was always declining for the last 20 years anyway as women exited the workforce. But it's not going to stay at this low rate. It's impossible, I think. Very difficult to imagine why 5 million people would permanently exit the workforce. So it hasn't snapped back as quickly as one might have expected, but job growth has been very robust. And I do think the participation rate will come back in, and that will take some pressure off wage and price increases as well. And economic activity, I think with consumers are in good health. We talked about this before. They've got a lot of cash, more people are back at work. Confidence is a little bit generally pretty good, although the last month took a bit of a hit because of inflation. But I think we'll generally see economic activity continue to expand. We had a good retail sales number this morning, much better than expected. So people are out there; they're not sort of hiding under a bush, scared. So here's the US, got a little bit of an uptick there, and that's why I'm kind of thinking that yes, we're back to 7-day rolling average rates, which we were in June. Obviously, they spiked for reasons that we know about, but the same as they were about a year ago. Now, this little uptick is I think what we're going to be living with, because as you know, vaccine rates are not uniformly high in the country. So we might be looking at these kind of numbers, which is going to kind of lurk in the background as an issue for a while. Europe, you could little upticks in Germany and France and Italy. Throw in the whole European Union, and it's not as strong as it would like. So these are still very much sort of in the background, flatline, but not necessarily sailing into great territory where it's going to grow good for a long time. And then just look down in the United States. Here are all the other states. I'm bothered to name them all, but they're kind of bumping along the bottom. There's a few up here. I don't think this one's Oklahoma or something like that. But you can see that generally the numbers are improving. Here's Florida. It's got very weird data, which it kind of goes flatline. They don't report it as often. Can't think why, but they don't report as often as other states. This is signaling my internet connection is unstable, but that just could be part of the course. You text me if it's coming through. In other states, it's it's kind of low and flat. So, but big improvement. Yeah, my concern here is that look at this; it's all over the place. These are per 100,000, so this could be a very sparsely populated state. It's probably Alaska or something like that. And again, but really, what you're looking for is for this all to be trending down and stay down. It's not. It's sort of it's kind of all over the place. So that's why I think that the COVID-19 green light we're out here, it's all going to be great. May not be forthcoming for a very long time, and then you throw in political issues around COVID, and you might be looking at this as a backdrop of uncertainty for a while. Here it is, the Q3 GDP number. Yeah, this is the estimates put out by the Atlanta Fed. They're usually pretty accurate. They started out the quarter at 7, very quickly during the quarter revised it down, and they were right. It came out at 2%. Right now they're back up at 8 again. Obviously, it's still relatively early in the quarter, but if this stays like this for the next couple of weeks, gets us into late November, early December, then this 8% turnaround in GDP should be pretty secure. So the economy is definitely coming back stronger after the third quarter delay. Now inflation, very big debate. You'll hear a lot about it. Inflation is something that people feel. They may not necessarily know all the details, but if I ride a motorcycle. It used to cost me $15 with California gas, which is the most expensive gas in the country, to fill up a 4-gallon tank. Now it costs me $25. So if I was, filling up an F-150 or a Dodge 1500 Ram, two most popular vehicles in the country, that's got to be a lot of money. So people will feel that inflation is around, and then they'll be in food prices and so on. So it's a very kind of visceral reaction. You can show them the numbers and say, well, it's only in some areas, so stop doing this. But people feel inflation, and it's hitting the headlines. There's a debate about it. Some are uneasy about this. Is the Bank of England, they've got a different set of problems, but they're uneasy about surging inflation. Yellen says she's in the camp of it will eventually subside. That's pretty much what the Fed thinks as well. And so interesting is the BIS, I put a lot of credibility into it, and that's the Bank of International Settlements, and it's made up of a bunch of very inflation hawkish guys, but they kind of think that it's emotionally transitory because of supply issues and demand coming back quicker than supply. But anyway, this debate is certainly out there, and you'll read a lot about it from almost every source out there. So let's kind of look at it. So I've put in a long inflation numbers, so we kind of know what we're looking at. This is what, for my age, you kind of remember this. It's like 70s. It was 13, 14, 50, and then everything sort of began to get under control. You got the core CPI, which is this green line, gradually falling down from about 4%, and then it bottomed out at about 2% for most of the last decade. And then the headline CPI, apart from a few occasional spikes, which it tends to do in a recession, suddenly we're seeing these prints of 6%, which, this is where you get the headlines. Oh my God, it's the highest inflation in 30 years. And they're going back to here. And in the case, I think the core CPI, it may be back to the early 80s. But I would sort of say, hang on a minute, this is a relatively short period we're talking about. So eventually, I think there's a lot of deflationary forces in the economy, which will bring this under control. Shelter is very important. It's 33% of the CPI. And that has definitely ticked up, and that's driven primarily by rents and the prices of houses. It doesn't care. It doesn't measure how much you paid for your house. It measures, the way they do it is they call up a homeowner and say, if you could rent your property now, what would you rent it at? And what people go through their minds is, well, my mortgage is X, and my neighbor's house just went for 600,000 and I paid 500,000, so I'll just plug in a number. And they do that, and there's nothing wrong with it. And they will also use some rents from around the area to sort of calibrate that as well. But it is a weirdly computed measure of inflation. It's just so important to the CPI. It's only taken twice a year. The survey is only done twice a year. Between that, they kind of extrapolate what they think is going on in rent. So that's a long-winded way of saying that it has popped up. I think some of it will ease off a little bit because this includes utilities, some utilities, which is not meant to include, and they take it out when they readjust the index. But this is definitely, this shelter component, which has come up from that V, is very important to the overall CPI and is likely to sort of stay about this level for the moment, primarily because rents and house prices are kind of behind it all. But it does stand out. If you zoom in on this, you kind of go, all right, it went up a lot, from, this is the last couple of years. But you can see from September, October, we're sort of tooling along at 1.5, 1.6, bang, April, we go up to 3, and suddenly we get 4 hits at 4.5%. But another way to look at that is this went up a lot, but this is leveling out. It's not accelerating. And I think that's probably what we're likely to see. I can't see that the big surprise here was, again, the used car, the opening index, the opening sectors, and a little bit of the shelter. But if this is what we for the next couple of months, 3 months, but I think we will, 4.5%, it's going to level out. It's not going to sort of keep on accelerating. What markets don't like is this kind of stuff, where it kind of goes from, we all thought this had under control, and suddenly doubles in a very short space of time. This is more about, leveling out inflation, I think, so, and not accelerating. So that's currently, I think, what we're likely to be seeing. There it is for the last 5 months. These are some of the sectors that got all the, just takes you back to, I have to move something here. This takes you back to a year. So used car prices, this is car rental, this is your up 35%. Used cars up 28%, new cars up 10%. And these are obviously things that people experience. Here's the airlines one, which was up in the summer and then got clobbered by this Delta wave down again, but that will start to go up. But if you look at these over the long term, used cars and new cars price level has nearly zero for 25 years. Very, very little inflation in used car prices. So these are not going to stay that. They are, I think, bottlenecks, the reopening, demand slightly higher than thought, some staffing shortages, all this kind of stuff. But you simply do not get a used car CPI running at 28% year after year, because the gap between new used cars is already very, very tight. People say, no, I'm not going to do this. And there's also a huge shortage of supply of used cars right now at the same time as there's a chip shortage for the new cars. So my point is that, these kind of make sense that they've gone up, but not the kind of industries where they can ratchet up price increases year after year. They're going to subside. As I said, the long term is 0 to 1%. They can't sustain price increases of double digits. This is a great slide from a guy called Matt Klein, whose blog is well worth reading if you've got time. But essentially what he's done is break out inflation between the core inflation and then what pandemic idiosyncratic categories, which is essentially all categories we've talked about here. It's down at the bottom. Cars, trucks, new vehicles, so they've got supply problems. Energy come up from restaurants, hotels, air. You'll know the story there. They closed down, they opened up less capacity than they down at. Admission to live events, club membership. How many of us said, well, I don't really need the gym membership because I can't go to the gym. So, I'll quit that. And then gyms opened up and they saw more demand. They tried people to come in, and their prices went up year over year, because like a year ago, no one wanted how much prices, people didn't come in. They're able to get those prices back to what they were. Tuition and childcare, car and truck rental, motor vehicle insurance. That's another classic one. It's like, I'm driving less, I'm at home, I don't have to commute, I'll drop the car insurance. There's no penalty for doing that. So car insurance premiums decline, then everything reverses and they come back up again. Anyway, so if you kind of take out those pandemic idiosyncratic categories, you can see they're a very large part of total inflation. So this was the monthly one, 0.9%, and 70% of it is those pandemic categories. So here it's a little bit more core. In June, it was those guys again. So this is going to continue for a while. This blue is still going to dominate this bar, I think, for the next few months. So again, I kind of am in the camp of eventually these will subside. Whether not in 1 month, but it won't take a year, and eventually we'll start seeing back to 0.3, 0.4%. So what's the financial market doing? Well, this is the quick answer on that, is that the financial market, and you'll see in a minute, the consumers think this, that inflation will increase or be 4% current inflation, core inflation will happen for the next year or two, and then will subside. In other words, it'll start to come down at some time in the future. And all this does is look at the Treasury market, which is pretty good as an indicator of what people are feeling, and the TIPS market, which is the Treasury inflation protected securities, takes the difference between the two. So the yellow-green line, colorblind, so not the blue one, it says right up at the top, sorry, it's faded, basically says that the market expects 3.17% inflation over the next 5 years. But if you look at the 10-year number, it says that's going to come down to 275. So that's that's nearly 50 basis points lower. And if you took the 30-year one, which I didn't bother with because it's 2%. So very important to remember here is that if the inflation story was in a sort of place of, my God, it's out of control, this would be the other way around. You'd see long-term inflation numbers, much higher than short-term inflation number expectations. What the market is really saying is, yeah, we're kind of braced for slightly higher inflation, but then eventually it will kind of revert, and the deflationary forces will come back into play. So that's kind of one measure. And consumers, I think, are doing the same thing. Now, this is we looked at what consumers feel confident about buying stuff. We just looked at large household durables, washing machines, vehicles, and there's other ones as well, but we took these ones. And people are asked, is this a good time to buy a large a washing machine? Some people will say no. The difference between the two, I think, is a good indication of just how much people are saying now is not a good time to buy. You can see, for a durable, it's like, this is the worst time to buy since ever. And for a car, worst time to buy since at least 1980. Now, this is a little bit counterintuitive. The way I read this is, that means that people are saying they're going to postpone the buying. It doesn't say they're not going to buy. They're just saying now is not a good time to buy it. If inflation was really going to take off, you'd buy it straight away. If you really thought that your washing machine was going to cost 20% more, 6 months from now, you get out and buy it. If you think that it's going to be cheaper, then you're going to postpone buying it. So that's, there's other elements of that, especially with housing as well. People are saying now it's a good time to buy a house, but it doesn't mean I don't want to buy a house. And if I can get the loan, then I will do it when I think that prices come off a little bit. If this was off the charts up here, where more people are saying I'm going to go out and buy stuff, then you say, well, then there's a lot of demand chasing supply, and that's likely to be a problem on the inflation side. But here you've got more people saying, actually, I'm likely to postpone this purchase. So they obviously think that inflation might come down a bit. And inflation expectations are really important. A difficult thing to put your finger on it because it's so personal. But generally, people are thinking, yeah, now is not a good time, but I think that prices will subside. If they think that, then eventually they'll come back to the market. And importantly, they won't be asking for a lot of high wage increases. This is the one I keep on coming back to because I'm just a big believer that you need real wage increases. This was the real wage increases that were last year. No one really worried about that, themselves included, because that was just the labor market falling, the market. This shows that if you're an hourly earner, blue one, or of hourly earnings of productions, and you throw over weekly as well, because hourly can get a higher hourly rate but not be employed so many hours a week. You can see that they're all kind of running in here it is, the the average weekly wage is down 1.5% year over year, and it's been running negative for most of this year. So you don't get a huge amount of consumers until this number's up in the 1 to 2 area. So this is obviously something to watch when a wage might catch up at some point, and the employment cost index only comes out every quarter. This is every month. It does tell me that at least, while we're hearing about wage increases, and personally I think it's a very good thing for the economy. Generally, wages are not keeping up with inflation. They're not keeping up with inflation. You're not going to get a lot of inflation. Definitely, the jobs market is mending. This is 531,000. We're going to need some more. I think we're going to get them just because we had, 2 months of pretty disappointing numbers, and this unemployment number is going to start to fall gradually. So this is, if we get 100,000 in November, God forbid, and the will go super easy, and the economy will be a big question mark about how fast the economy is recovering. If we get another 500 and going into the new year, 7, 8 back to here, then I think we're on a very good path. I think that's where we're heading. I do want to talk about some inflation strategy. So this is from high level down to more tactical level for portfolios. So think about inflation. Obviously, one of the first goals of investment strategy is to preserve your purchasing power. So if inflation's running in a CD zero, in about 20 years' time, you have half your purchasing. So it's not a good. So clearly, one of the to able to ensure that a portfolio stays ahead of core inflation. And most of the time, the assets investments we do that. There are times when there are inflation added to fall, and a lot of them have pros and cons. The short answer is very to guarantee you would be probably is a guarantee very high price. But I'm going to talk about, I'm happy to send this on to people. We're going to protected securities, Zion bonds. I read up in the blog a couple of weeks ago. Everyone's eligible for it, but you can't put money in there. Quite a good investment. You have to buy them direct from the treasury though. Commodities have to be, I think, with extreme care. The bond ladder, we use it for a number of clients that has good inflation. All of these have good inflation strategy. Some are better than others, some are more short-term. Floating rate notes, which are just bonds whose coupon changes every couple of months. Gold, I think, is a terrible inflation hedge, but I think otherwise, so we kind of put it in there just to make sure that our assets don't carry over month. They do, but anyway, we just check that they don't. Foreign exchange, I mean, there's absolutely, if you're in a high inflation environment, and particularly in the 70s, if you were in the what was then the Deutschmark, Swiss franc, still around, of course, the yen, that offered quite a lot of inflation protection. Equities, these are the kind of sine qua non investment strategies to beat inflation. Not all of them do it all the time, but over time, equities are a pretty good inflation hedge. Why? Because they sell in nominal dollars, and they will generally increase their sales in line with inflation, and that'll kind of flow through to earnings and dividends. So if you really think inflation is going to be 20%, you're going to be overweight in equities, very underweight in bonds, unless those yields are tracking up as well. Real estate, there's lots of different flavors of real estate. What we're talking about here is real estate where there's leases which have some CPI adjustment to them. There's quite a few that do, whether it's in housing or storage or commercial. A little bit with retail and also with office. Real assets is something we're looking at. We haven't really invested in it yet, but there is kind of farmland and timber, which are pretty good inflation hedges. They don't always, it's not one for one. Sometimes they have to kind of wait for it to catch up. I put crypto in there. We've done a little research of crypto over the summer. We're putting out a paper which is available, and we'll put it up on the website. But I mean, one of the advocates of crypto is, of course, it's an inflation hedge, which I think is utter nonsense. But just because an asset goes up 500% doesn't mean it's an inflation hedge. You could say Tesla's an inflation hedge at that point. But anyway, it is there. And we don't want to take our eye off it. It's easy to dismiss right now, but who knows what it'll come. Tips. Tips are good. The tips will give you the CPI index, no doubt about it. The problem is that you don't necessarily want to be in them if the inflation is low. This black line is what inflation got you. This is what tips got you since 2017. So you made a total of your $100 turned into 106, 107 on the CPI, turned into 109 on the tips, but your corporate bonds gave you 111. Actually, this is corporate treasuries. So at that time, tips did better than inflation. Yay. They didn't do as well as corporate bonds. So you kind of got to get your timing right. And this is where it's worked. From the beginning of 2020. Actually, it's nearly all here. Over the summer, you've seen again since last January, your CPI is 107. Bonds haven't kept up with, and tips have. So they can be good. You just can't necessarily hang out in them indefinitely, because if you had tips for 20 years from 2000 to 2020, you'd be a very disgruntled investor. You've probably got less than 1.5%. And there were plenty of other assets a lot better than that. But we are looking at them right now. If you buy a 10-year tips, you're locking into a 1.16% negative yield, because people know what they do. They like them. But these are very overpriced right now, and so they're kind of expensive inflation insurance. So we've got to be careful. Get into these. We get into in the right way. We do have a small exposure through them, through one of the funds, Western, which most people have. But if we kind of go out on our own, and we're kind of looking at what that might do, and whether we use an ETF or whether we do it direct. So watch this space. But they can work. But if inflation subsides back to 2%, then they weren't very pretty. Commodities. Pretty awful hedge against inflation. In the short term, you can get spikes like this. Look at that. This is kind of all commodities lumped together. So you can put in your metals, nickel, aluminum, copper, all the industrials, and you can put in some energy there, and you can put in some precious metals and everything else. It doesn't really matter which one you use. They're roughly the same behaviors. So here you go. You did really well with your commodity index. It went from 300 to 500, and much better than inflation. But look how volatile it was. And over the long term, simply done it, just because there is a shortage of these types of commodities, and they requires less input of commodities per unit of GDP these days. So again, something you're going to have to get in. And I always say commodities, where you do silver or nickel, oils, like when you get in, you've got to have an exit strategy. If you hang around in those commodities, you will get absolutely burned. Here, even in you made no money for 28 years. Then here you made money out of 2008. This is all China basically, and had it all collapse. So it's something where you've got to be very careful. It doesn't matter whether you buy the commodity or the mining companies. It's the same issue with gold too. It doesn't help you to go to miners. The bond ladders we like. This very simple concept is that if a 10-year getting you today, and a 1-year bond getting you 50 basis points, and rates going up, and they're going up because inflation's going up, then as this matures, you just invest it at the lower end, and this then is all kind of just ratchets down a bit like a Tetris thing. So this one becomes the 1. This one becomes the 2-year, and so on. So if interest rates go up, this is a very good cap for the change in interest rate. We do use this, and interest rates stay positive on a real basis, which they're not right now, but we will. Then this is a way to capture that. Floating rates. This is this red line. A very, very steady investment. Apart from what briefly happened in March last year, but the bond market was even worse. So you're essentially getting a very, very steady rate of investment. In theory, you should inflation, and we like them. We've used them from time to time. We're using them for some time now, but really the bet is the borrowing rate keeping up with inflation. We do, which it does, but it's kind of steady, and we've used. I thought it would have been rude about gold. Here we go. I can prove now. Yeah, it looks. This is what most of the gold bugs say. Gradation index. You kind of go, okay, but gold was really regulated for 70 years until Nixon came off the gold standard, and it had a huge rocket, and then if you put it in 1980 or silver market, you to make your money back. And it had another run. People got scared out of the GFC. But anyway, you kind of see that for the long time, it's great. You made $9,000 off a $100 investment. Inflation's at 1,400. You're all ahead. But I'd say, you kind of chop this up into different elements. You'll find that it doesn't do that job at all. Here's a good period. 5 years, the gold price absolutely plummeted. Inflation went, on ahead, albeit at a lower rate. And now you're, way behind. So I think gold is more of a low rate. You don't get any interest on gold. You don't get coupons. So the holding costs of it are less in a low rate environment, and in a slow growth area, it can be reasonable. But we kind of normally stayed away from gold, and its inflation beating properties are far inferior, I think, to equities. Equities work very well. Here you go. Going back to 1960, your $100 turned into $7,800 nominally. And in real terms, this bottom line, this is the CPI multiplied by the inflation number, it's $816. So you have more than kept up with your purchasing power. So they've been a very good inflation hedge. Sometimes they don't do as well, but generally they've done very well. And right now we have, remember that real rates are incredibly low. Here's the federal funds rate less the rate of inflation, minus 6%. And when we're this low, I wouldn't take this as a direct chart of everything on here as gospel, but generally, if you've got low rates, low real rates, again, some of the 70s might mess things up a bit, but you had some pretty good returns here. 31, a 19, a negative 11, a 1, a 12, and a 25. So it really, it's around places like this. This is obviously the tech crash. This was the GFC, minus 38%. These are not, these can happen, but they're really independent of the real inflation story. So I guess my summary on this is that real rates are low. That still makes it quite attractive to companies to borrow. So you're not stifling, you're not turning off the economy, and the willingness for people companies to invest. A quick dive down. So we kind of took some different scenarios here about, okay, what does high inflation mean? Well, we just took a cut of 3%. And what this says is that if you have 3%, less than 3% inflation, but it's rising, equities outperform that inflation 90% of the time. And if you have high inflation above 3% and it's falling, equities outperform 76% of the time. And this is low inflation and falling, like from 3 to 2 to 1. This is high and rising, 3, 4, 5, 6, and it's going to stay there. This is when equities don't do as well, but still, half the equities do better than inflation. So if this was all the way down here, then you'd have to look for a different inflation hedge if you felt that inflation was high and continuing to accelerate. But generally, equities are a good hedge against inflation, which is what we've kind of started out with. But here's the but. In periods of 3% and rising inflation, here we are, that's what I've written up here, you have to look at what sectors do well. So the S&P 500 will generally, just as we saw there, 48% of the time will outperform. But the sectors that do really well in inflation is the guys up here in the top right. So energy, you probably want to be an energy stock right now, but Exxon's up 60% over last year. equity REITs, which we are in. We like those. And also you want to be in consumer staples. Why? Because most consumer staples have pricing power. If you think of, Clorox or Bounty or Heinz or Coca-Cola, God forbid, but that is considered a staple. People do go out and buy them, not regardless, not regardless of price, but they've got, people will still buy them even as inflation goes up a little bit. So consumer staples tend to have good pricing. So do utilities, because they just go to the regulators and ask for a higher level of return on capital. What you don't be in is mortgage REITs and consumer discretionary and tech. Techs don't typically pay a dividend, so a high inflation means you're just going to discount them by a higher price level, and they're not worth as much. So if you remember, this is a 3% accelerating environment. So that's the things you want to be in. And we've got some of that already. We've got the equity REITs, we've got consumer staples through the dividend aristocrats. We haven't got a big exposure to energy. It did very well in the 73 to 2020 period, which could be quite there again. But the point about this is that, you do have to kind of pick and choose what equities you think are going to do well, because this is the history of it. Real estate, I think we've covered, that definitely works. This is just S&P 1500, which includes the mid and small caps. Now, these guys have leverage, so that's in favor and with low rates. But obviously, it's absolutely crushed the CPI made 100 last 20 years. Made money in real estate. Crypto, I don't really want to talk about crypto. It's incredibly expensive, and it's also very volatile. But we despite the being very good about it, are looking at it, and there are ways to invest in it, not just go out and buy more Bitcoin, but also through companies and things like that, whether it's Square or PayPal. There's ways for us to get it as well. So I guess that run through on the investment options. As we sit down with clients, we're kind of thinking about these inflation investment strategies. Some we've kind of got already. Some to execute more if we thought inflation was going to hand a little bit, but for the now, I don't think that's likely. So summary, COVID-19, Matt may look around for a while. I just think that you see that little clip up in the US, I just don't think we're going to sort of put it all within 6 months. So depending on how those winters, acceleration rate, breakout rate, I think it's going to be lurking in the background as a bit of a ghost. It's like, is it going to come back at us again, or is it going to go away forever? I think it'll be around for a bit. Consumers seem to be postponing their purchases. I have a good November, December, not rushing into them. And remember, the households generally are very flush with cash. The extended unemployment benefits and people being paid if they stayed in jobs means that there's a very high level of cash, and also people have made a lot of money, whether it's the stock market, crypto market, $3 trillion. Now, that wealth, you can argue whether it should be that big, but there's roughly $3 trillion. Well, you have to cut it off a little bit because some people lost their coins permanently, so it might be less than 3 trillion. Less actually, but still, there's $3 trillion of wealth out there just in crypto. It's going to make people, if they want to purchase, able to purchase. And will be a headline for a while. So just strap yourself in. You're going to hear about it, and I think it's going to affect voting patterns if it persists, and people's outlook on the economy. I don't think we're looking at a broad general increase in all prices now. If it's 5%, 4.5% on the core. January, February, then we'll have to think again, but I don't think it's going to happen, primarily because of the wages, which is the next one. Hiring has picked up. It should stay strong in the coming months, if the economy stays. So we think that's generally a good pattern. And the Fed is tapering, but conditions are still incredibly loose. So we're not sort of in a period of where the Fed is about to take us to much higher levels of inflation. So I know it's a bit of a run through. This will be up on the blog, and the slides I think will be available as well. We do have some Q&A, I think. Copy of the slide deck available. Yes, I think we can make that happen. Happy to put that out as a PDF. Will all tech do badly in 3% and rising inflation? I own tech. No, I don't think so. I mean, there's some tech which is, depends if you call Tesla tech. Let's not call it tech for now. It's just a car company. But I think there are some, tech companies which are on pretty high multiples, but they're also incredibly profitable, especially the big guys. So I think they haven't really been tested in a 3% inflation environment. I think in the initial reaction will probably be a sell-off in tech. People want more kind of real income protection. They'll get it. They can find it more easily elsewhere. But I don't think it's gonna sell off. And I think we've also invested in a ETF called XPND, which is kind of a nice little ticker for expanded tech. And we've kind of gone into tech companies like Adobe and Trimble, which are huge cash generating machines. And in the case of Adobe, pretty much sells its entire 12-month output on January the 1st due to subscriptions. So I think there might be some still think they're going to be a pretty strong part of the economy and sector. What are you driving that takes 4 gallons? I'm driving a Kawasaki Versys 650. It's a 2-cylinder motorcycle, and I can go 220 miles on that. But anyway, it used to cost $15, and now it's let's say 25. It's a bit of a shocker. So that's how I get around. Nice to hear from people. Sound is good, still sound good, sound is good. Christian's audio quality is pretty poor, only understand. I'm sorry about that. I hope that picked up a bit. I don't know. We'll have to try a different time, a different feed next time and see if we can get better in that. Let's apologize to anyone who had poor audio quality. Maybe it'll show up in the recording. Well, look, thanks very much. Sorry to take up your time. We'll do one more of these, obviously, before the year end. But I think generally we've been in a very good environment, and now we're sort of facing this inflation change. I don't think it's a regime change, but certainly different from what we've been experiencing. But I think with the other parts of the economy, especially employment and output, and today, like I mentioned, retail sales up, we're the economy's in pretty good shape. Okay, with that, I will give you a pause to brace yourself for the disclosure. This is where I kind of lose people. I can't think why, but let's see if I can get that. I know it's here. It's all that's coming. So if you're a disclosure guy, don't feel that you have to listen to this. Okay, discussions of the investment strategy, research, investment process of Brown Janikowski are of the date indicated, or is it the date of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the types of investments mentioned in this presentation will produce the intended results or outperform any investments in the future. We reserve the right to change our investment perspectives and outlook without notice as market conditions dictate and as additional information becomes available. Diversification does not protect the investor from market risk, does not ensure profit. The information is subject to unintentional errors, omissions, and changes without notice. All sources are from FactSet unless otherwise noted. While we gather this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in the presentation. References to individual securities should not be construed as a recommendation to buy or sell that security. The securities noted in this presentation are only several of the successful as well as unsuccessful investments by Brown Janikowski. Do not represent all the securities we have purchased, sold, or recommended. Index returns include in reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual funds return include reinvested dividends, capital gains distribution, mutual fund returns on net fund expenses. However, they do not reflect Brown Janikowski's views. Please read the prospectus carefully before investing or setting money. Past performance is no guarantee of future results. You may reference various hypothetical investment illustrations. They are for illustration purposes only, not an investment recommendation. Do not guarantee indication of success. Big congratulations to Valentino Rossi for his retirement from the MotoGP. 9 times world champion. We'll never see his title again. Thank you very much.